So mid last year, I did something that I've been looking forward to doing ever since I started investing, and that was finally opening up a taxable investment account. Now, the reason I was so excited wasn't about the account itself, although I was excited about that too, but it was because I'd gotten to a place in my investment journey where I'd maxed out all of my registered investment accounts. So that's my TFSA, FHSA, and RRSP first. And that's a milestone that a lot of people set out to achieve when they start their investing journey, so it was very exciting to hit it. Now, a taxable investment account is also sometimes called a non-registered account, and it's basically a standard brokerage account or a standard investment account that you can use to purchase investments inside of. Now, it's actually one of the easiest accounts to open up and get set up with because there really isn't much that you have to worry about at first. As long as you're a resident of Canada, you have a valid SIN, and you're 18 years old or older, you're able to open up one of these accounts and start contributing as much money as you want to inside of this account without thinking about much else. Now, the reason that so many people, including Dennis and myself, choose to open up and invest inside of registered investment accounts or tax-advantaged investment accounts first is because of the tax benefits that you get with them. Now, with the taxable account, the main benefit that you get there is that you have the ability to invest and contribute as much money as you want to. There's no contribution limits, which makes this account very flexible. However, you do have to pay taxes on the income that's earned from your investments. That means that there's no tax advantages to this account, and it's also your responsibility to keep track of and report all of the activities that occur inside of this account every tax year. Now, most brokerages will typically provide you with a tax slip that details this information, but like we've said in the past, the government and most brokerages will typically remind you in their FAQs or in the fine print that it's ultimately your responsibility to make sure that all of this information is accurate. Now, there's actually a lot that we could talk about when it comes to taxable accounts, but in today's video, we're specifically going to be talking about ACBs. So how you can track your adjusted cost base, along with why it's important, how it works, and what you need to know. We're also going to use my ACB as a real life example to help make things as simple as possible. So let's get into it.
So before we get into calculating an adjusted cost base, it's actually really important for us to talk about what investing inside of a taxable account looks like. Ideally, if we can get on the same page on the basics, it'll make everything else that we talk about make a lot more sense. Now, to keep things super simple, when we talk about investing inside of a taxable account, this is typically what it'll look like. You put money into the account, you buy investments with that money, and then when you allow those investments to grow, hopefully for many years, when you go to take that money out of that account, so at this point you've sold your investments, you have to pay taxes on the sale of those investments. Now, the last part is what we call capital gains tax, and it's one of 3 direct ways that you can be taxed when you're using this account. I feel like the idea of capital gains tax is something that many people are familiar with, but it's basically when you buy an investment and it goes up in value, you then have to pay a portion of that growth to the government in the form of a tax. But here's the thing, this just isn't the whole picture because there are 2 other ways that you can get taxed. And that's when interest is paid out to you from your investments and when dividends are paid out to you from your investments. All of these are events that occur inside of your taxable account. So whether it's purchasing and selling investments, receiving dividends and interest payments from investments, it's ultimately your job to keep track of everything that's happening, which brings us to calculating your adjusted cost base. So if you're wondering what this is exactly, to keep things simple, an adjusted cost base is the total cost of buying and ultimately owning an investment. So if someone came up to you and they asked you to calculate an adjusted cost base, you would keep track of things like the initial purchase price. You would adjust the price as you bought and sold more shares, so calculating the average cost or continuing to calculate the average cost. You would adjust it for any fees and commissions that you had to pay. And probably the biggest part that people often forget or don't know is that you have to make adjustments for any external events that affect that particular investment. So this would be things like dividend reinvestment, so that's the purchase of more shares using your dividend payouts. Something called phantom distributions, which we'll explain in a bit. Something called return of capital distributions, which we'll also explain in a bit, and corporate actions, so things like stock splits, for example. To put it lightly, tracking your ACB is very important, and it's a requirement if you're someone who is especially investing inside of your taxable account. Now, some of you might be listening to this thinking, wait, my brokerage issues a T3 and a T5008 for me every single year that has all of these calculations already done for me. So why do I need to calculate this myself? Well, the reason that it's important to keep track of this and calculate this yourself is because your brokerage will likely be the first one to tell you that they can't guarantee that these calculations are 100% correct. Sometimes investment platforms just aren't able to include certain adjustments based on their capabilities. And as you'll notice soon, some of the information that's required just isn't the easiest to compile, let alone pull for thousands of customers. For instance, your ACB has to be calculated across all of your taxable accounts. So for example, if you hold the same ETF across multiple different investment platforms, there's no way for one particular platform to have all the information to be able to give you that full picture. Now, you also don't want to be in a position where your ACB is wrong, leaving you in a place where you've paid too much in taxes, because why? Or paid too little in taxes, leaving you in a position where CRA is asking questions and honestly just charging you penalties at that point.
So when it comes to the calculations themselves, as you can imagine, the amount of work that goes into calculating your ACB can vary depending on the number of investments that you hold inside of your taxable account. For many long-term passive investors, you'll likely see a very tailored number of ETFs inside of their account, which makes doing these calculations a lot cleaner. But for people who take a more active approach to their investments, you might see more holdings and more activity because they buy and sell investments more often, which can make doing these calculations more complicated and very tedious. Now, the reason that this is important to highlight is because these calculations have to be done for every single investment that you hold. Whether you own 2 funds or 15 stocks, you have to do the same calculation for each individual fund and or stock that you own. Now, what's interesting is that from a timing perspective, March is ideally when we want to be fully updating your records, right around the time that we roll into the official tax season and that you're filing your personal tax return. Usually at this point, companies and ETF providers have reported their tax breakdowns for their funds, and they've compiled all the information that you'll need in order to make adjustments to your ACB beyond what's occurred inside of your investment platform. So beyond you buying and selling more of your investments, for example. So to start, what you need to do is pull all of the information that your investment platform has on your activity. So this could be in the form of the statements they provide, usually either monthly or quarterly, or it could be as simple as you going into the activity section of the investment platform that you use and looking at everything that happened line by line. What you'll find here are the different buys and sells that you made throughout the year, and also any dividend reinvestments that also happened throughout the year. Now, what you need to keep in mind as we dive into this real life example is that buys, dividend reinvestments, and phantom distributions increase your ACB, whereas sells and return of capital distributions bring down your ACB. Okay, so now let's take a look at what we're dealing with here. In 2025, I opened and purchased VXC inside of my taxable account. Now, I did this consecutively once at the beginning of every month for 6 months starting in July of 2025. That means that I had a total of 7 relevant transactions that happened during that period of time, and we're actually going to throw them up on screen for you to see. Now, keep in mind that the date shown is the settlement date, not the original day that I made the purchase. Now, as you can see, I had 6 buys and 1 dividend reinvestment during this period of time. And because I'm a passive long-term investor, I had no sales of investments. Now, what's also interesting and must have something to do with the way that the trades are executed and settled on Wealthsimple is that you can see that there are months where there's 1 cent that didn't get invested, but then you can see that everything gets invested in the months that follow instead.
Okay, so now we have to move on to the external events that might impact your ACB. And by external events, we mean events or activities that occur outside of your investment platform. For this information, we're actually going to get the tax breakdowns for VXC because that's the ticker/investment that Steph specifically had invested in. And for this, we're actually going to go to cds.ca. Now, this is a free website and tool that's owned by the TMX group, and it basically compiles data and allows people like us to have a centralized place to find any information that we're looking for on a particular fund. We're specifically going to look for the return of capital and phantom distribution breakdowns that'll help us calculate our ACB. But before we even do that, let me explain what both of these calculations are. So first and foremost, these 2 calculations are only going to be relevant when you're calculating an ACB for an ETF, mutual fund, REIT, specific trust companies, but heavy on the ETFs because that's what we focus on. For single stocks, your ACB is generally only going to be affected or impacted by things like buys, sell, dividend reinvestments, and stock splits. So this next part, won't apply. Anyways, when it comes to the return of capital, this is what's called a non-taxable distribution. And to make it even more simple, it's basically when a fund gives you back a portion of your original investment. So it's not considered income. Phantom distributions, on the other hand, are a taxable non-cash distribution. And even though they sound mysterious, hence the word phantom, they're also sometimes called reinvested capital gains distributions. And it's basically when a fund gives out or distributes cash, but you never actually physically receive it, and you're taxed on it. So now if we go back to the CDS website, let's find these calculations for VXC. So here's what you would do once you got onto the website. So what you would do is you'd actually click at the very top, you'd click solutions, and then you would scroll down to tax services. And then once you hit tax services, you'd click tax breakdown services. You would at the very bottom right, click display tax information for the year of 2025. And then you would agree and accept the terms of access. And then what you would do is you would actually look for VXC or for whichever investment that you're looking for. So what I'm gonna do is I'm actually gonna filter by the security name. And then what I'm gonna do is I'm gonna scroll down and I'm going to find Vanguard FTSE Global All Cap excluding Canada Index ETF. Now from there, I'm actually going to click on the PDF that I see at the very right and open up that document. Now in this document, we'll find 3 key pieces of information that we'll need. So the first one is actually the record date. So you'll see that right here at the very top. And then the other ones are the total non-cash distributions per unit, and then the return of capital. So now that we have all of this information, what we're gonna do now is we're actually gonna make our lives a little bit easier, where instead of using Excel, we're actually going to compile all this information and input it into another free tool that's really great for investors, and that's adjustedcostbase.ca. In this case, we'll start by adding in our buys, our dividend reinvestments, our phantom distributions, and our return on capital. So let's start by adding in a new security. So we'll start by adding in the name and the ticker symbol. And then once we have that, we can start adding in our transactions. Now to start adding your transactions in, you can start by selecting the fund at the top. You need to make sure that your transaction is a buy, and then you also need to input your settlement date. Then input the total price that you paid for those shares, so the total, not the price per share, and then add the number of shares that were purchased, and then finally click add transaction. Now repeat this process in order. In our case, we had buys in July, August, September, October, until we finally hit our first dividend reinvestment, our first and only dividend reinvestment. In this case, you would follow the same procedure, but instead you would change your buy to a reinvested dividend. Remember, if you forget to include your dividend reinvestments, you'll likely pay more taxes than you need to in the future. After that, we'll include/add in our remaining buys, so that would be for November and December. And then once that's done, now we have our phantom distributions and our return of capital. So if we go back to our PDF, specifically the line that says total non-cash distribution per unit, each number of units that you see listed is going to be multiplied by the number of shares that you held on the record date that's listed at the very top. So if we add a new transaction, and this time we change our buy to reinvested capital gains distribution and include the record date as opposed to the payment date, we'll be able to add this transaction to our ACB calculation. Also, remember to enter the amount that you see listed in the PDF in the amount box, not the additional shares box. And even more importantly, this time we can change our total to per share. Now, the last thing that we need to add is our return of capital distributions. And if we take a look at the PDF, we can see that there were 4 distributions in 2025 that we'll actually need to add as 4 separate transactions. So if we again add a new transaction and this time change the buy to return of capital, then we'll look for and input the record date, enter the amount and change it to per share, and then click add transaction, and we'll repeat this process for the 3 remaining transactions.
So now that you're done, you can see all of the transactions that you've added. You can double check them to make sure that you've entered everything correctly, and you should have an accurate calculation of your ACB based on everything that occurred throughout the year. Now, we recommend that you create an account so that everything and all your data is saved and on file, but we also recommend that you actually download a copy of everything that you did for your own records. Now, luckily for us, we only had this one ETF to account for, but for anyone who does hold multiple investments, this is the process that you'd follow for all of your other holdings as well. Now, we know that this might feel like a lot of steps, but once you've done it once and you've gotten the hang of things, it can actually actually be pretty straightforward. It can just be tedious if you have a lot of holdings. Anyways, we really hope that you enjoyed this video. And also, as a fun exercise, you can actually use your tax slips to compare and see if you and your brokerage are on the same page, assuming that you only use one platform. And if you aren't on the same page, then either one of you or both of you are wrong, so it's definitely important to double check. We'll follow up in a future video actually doing that exercise ourselves once my tax slips become available later this month. But with that, please let us know if you have any questions at all down in the comments below, and we'll see you next week with another video.